Welcome to the Ultimate Option Rolling Master Course. In this course, you are going to learn so much that's going to help you roll options, manage options, and it's going to make you a lot of money as well as save you from making deadly mistakes. Rolling is the most important skill that you can learn when it comes to option trading. You see, whether you're selling options or buying options, whether you're doing covered calls, leaps, sell puts, doesn't really matter what the strategy is. Rolling can save a losing trade. Rolling can make you more money on a trade, and rolling can make you a much profitable trader so you can create that passive and retirement income, or simply make you grow your account a lot faster. So let's jump into it. Let's not waste any time. If there's one thing that successful option traders and unsuccessful option traders have in common, is it's having trades go against them. Whether you've been trading for a very long time or not such a long time, you probably experienced losses, right? I definitely have. I'm not gonna BS you. I experience losses all the time, but the main goal is to minimize your losses and to make your winners much bigger, right? So at the end of the day, you are a profitable trader when you're having big wins and small losses. So yeah, maybe successful option traders get into bad situations less often because they know how to pick better trades, but what really matters most is the successful option traders actually know the art of rolling. Rolling is really the game changer, and rolling is what will give you that edge against other traders. And it's the ultimate way to turn a failed trade into an extremely profitable one, if you know what you're doing, of course. So on the screen right now is everything we're going to be covering in this video. I don't want to waste any of your time. I respect your time. So here's what we're going to cover. We're going to start off by talking about what is rolling. That's the core idea. So let's start off with the core idea. What is rolling? So rolling means that you're closing a current option position and opening up a new option position. So basically, you are closing one that is not going in your favor. So maybe it went against you, or maybe it's going in your favor, but you see an opportunity to make more money. So that's what a roll is. It's simply that, nothing else. Closing one position for another. Most brokerages actually allow you to do that in one single transaction. Otherwise, you can close one trade and open up another trade. Either way, it's the same thing, replacing something that is worse for something that is better. Here's an example of a call option. Here's the market price, that's 190. And let's say that you buy a call option for 200, right? And now what happens is the stock moves up and it's closing for higher than the $200 strike price. Well, that's really good, right? But you can actually make more money by selling the $200 call option, taking profit off the table, and then buying another $205 call option, for example. So you can close one 200 and then sell another one. So you can sell one call option here for 200 and buy another one for 205 for a lot cheaper and take profit. This is how you would take profit on a long call option. Also, you can do this if you're trying to extend time. So it's a way to extend a trade, adjust it, or reposition without taking full loss or missing a future opportunity. And you're not starting all over. You're just moving from one trade and you're moving it to a further date. So you're trading it forward. You're increasing the time. And that's really what rolling is. It's only a factor of two things. It's time and strike. That's it. Because you're closing one option on the same stock to open up another option on the same stock, right? So you're just moving an Apple call option to a different Apple call option, or an NVIDIA put option to a different NVIDIA put option, or Tesla, or whatever stock that you're trading. You are just rolling it up by closing one position and changing the date and the strike price on it. So think of it kind of like chess. So you're sacrificing one move to gain a position on a next move, right? So it's kind of, very similar in that regard because you're changing one position's time and strike price for a different time and strike price. And that's really it. And it's not too hard to master, but there's a lot of little nuances that I'm going to teach you in this course. And honestly, sometimes it's not even a sacrifice. A lot of the time you get paid to roll an option. So the strongest thing that you can do, it's really the easiest strategy, is you get paid to improve basically your position, right? So let's say that you're going from point A to point B, and instead of, when you go to the gas station, instead of paying money for gas, you actually get paid to fill up your car for gas. It wouldn't make any sense, right? And that's exactly how powerful this strategy is. You're literally getting paid to improve your position. So if you're going to work, let's say that you have a very long commute, you stop at the gas station and then for some reason they gave you $50 when you filled up your gas. It would make no sense, right? It'd be a freaking amazing world, right? For most people commuting. And that's pretty much how this option strategy works. And the whole reason it is so powerful is because one of the strongest factors that is in investing and in finance and in option trading is time, okay? So when you add time to any option, it's always going to be worth more. All other things equal, right? Let's say it's the same strike price, the same, all other factors the same, time, massive factor, right? Because anyone can get rich if you have a ton of time. Like if I told you right now, hey, put your money in S&P 500 and wait 50 years, obviously you're going to get rich, but you don't have 50 years to wait till then, right? Like you're trying to get rich today, or you're trying to get rich soon, you want to retire soon, you don't have 50 years, right? But you would be like, duh, that's easy, right? Over 50 years, I am going to get rich. And that's because time. I just proved it to you, how important it is. So I'll talk more about rolling and getting paid to roll in just a little bit. But really the goal is not to never lose, right? Again, we can't really get away from losing on some trades. But our goal is to maximize our profit and to minimize our losses. So the goal is not to never lose, it's to manage risk while staying in the game long enough for the probabilities to work on our side, right? If we're investing in the right stocks that I cover, Palantir, Nvidia, Apple, Google, we got a lot of good stocks that I'm invested in. And if these stocks are going up, then it's really just a matter of probability. And if you're using options, then you're generating income. And for whatever reason, if one of your options goes into the money, rolling is your answer. Rolling is the only answer, okay? Really, it comes down to getting assigned or rolling. Really, that's it. There's only two things that you can do at expiration or nearing expiration. You can just kind of be hands off and let the option go or expire or get assigned, which is basically doing nothing because that automatically happens, or rolling, which means you essentially take action and then you are fixing the position or adjusting the position, you're altering the position. So that's exactly what this master course will be about. And we're going to do lots of different examples here, and I will go through different strategies where you should be rolling options. So really, rolling can be a defensive play. You can reduce your risk. It can also be offensive. So trying to capture more upside, or neutral. You can just be looking to lock in gains. So it's very versatile. And if you watch any sports, whether it's basketball, football, tennis, we're going to be talking about strategy. This is going to be really interesting. And I'm going to go into detail on strategy. How do we strategize a good roll? What does that look like? And by the way, I was covering this stuff only in my one-on-one coaching. And now I'm giving a lot of this stuff away for free. So you're getting massive value. So I'm making sure that my free content is better than everyone else's paid content. And I do still do one-on-one coaching. So if you're interested in that, it is the first link in the description. A lot of what I do is rolling and scaling and growing accounts faster and getting them from low six figures to multiple six figures and seven figures. And that's the goal. So I'm very excited to share a lot of this with you today. So let's get down to business. This works because of decay in the repricing over time, and you can use that to your advantage. Here's a chart of time decay or theta decay. And as you can see here, our options value is going down as the time approaches zero. So when there's 9 months left to an option, there's really a lot of time, and that's why an option is not really decaying that fast. But as it approaches expiration, this curve accelerates the options decay. And rolling gives you leverage over time, not just direction. So for passive income traders, rolling is one of the most important skills to master, and it keeps your system moving. So here's the mechanics of rolling explained, and I want you to know that most brokerages are okay. So if you're using Robinhood, Charles Schwab, Fidelity, Interactive Brokers, etc., that they're all okay, but they do have a slightly different way of doing things. Most brokerages just have a roll button, but you should understand what you're doing to understand what's under the hood. So if they don't have a rolling button, all you need to know is that you close out one option and then you open up another option. So you're doing this simultaneously, closing your current option position and opening up a new one. So step number one, if you're rolling out, you can use the same strike and just roll out till later expiration. I don't usually do this. It usually doesn't make sense because if an option is changing in value, you're usually rolling because something has changed, right? It's either in the money or it's getting close to the money, and you are rolling it because it's getting close to your strike price. So the number one way, or option number one, is not really used as much. Now, number two, if you're rolling up, you pick a higher strike price and same expiration. Now, this also kind of similar to number one. The number two way to roll is by increasing the amount of upside that you have, right? And going for the same expiration. This is also something that I rarely do. Instead, number three, if you're rolling up and out, this is what I always do, okay? So the first way is just really just same strike, but more time. The second way is higher strike, same time, but the way that I do it is higher strike and more time. So both rolling up in the strike and out for expiration. Okay, so that's the best and most optimal way. I'll show you some examples of that. Number four, if you're rolling down and out, that's also pretty good. So rolling down and out is very similar to up and out. Up and out, you would do that for a covered call.
and down and out, you would do that for selling a put. So, you would go for a lower strike price and a later expiration. This is very common for selling put options. Now, you're going to receive or pay a net credit or debit depending on the price of your roll, right? So here's two examples real quick. So essentially, a covered call, right? If you're moving from, November 8th to 2/21/2025, this is an old example, right? But I picked this out from like an old course that I made. So if you're going from the 13 call to, again, a 13 call, but you're adding a lot of time, because you're adding a lot of time change is 105 days, you're going to get a credit. Because anytime that you add time, you're adding on premium, because time is money. Simple as that. Time is money. Everyone wants to make money for their time. So the total credit here is going to be, hundreds of dollars depending on how much time you put, even on a pretty small price stock, okay? Now, here is a different trade. Here's a debit. So if you're going to go from 95, like let's say you had a 95 covered call, and you're going to, roll it up to 100, but you're only changing the date by like a month. Yeah, that's a big change from 95 to 100, and you're only adding 35 days. That's going to be a debit. So you can see here, that is a debit. So a net credit is when you're collecting more premium on the roll. And a net debit is when you're paying to adjust the trade. Okay, so of course, if you can roll for a credit, that's going to be usually much better. All right, so let's talk about rolling long calls and long puts. Long options lose value quickly as they approach expirations, so rolling can help you extend your outlook. So typically, I'm not buying options, but if you're buying options and what you want to happen is not happening, the option's approaching expiration, you already know that time decay or theta is going to eat into your option. So oftentimes you can extend your outlook by buying another option that is further out in terms of date. That's the most common strategy for long call options. So if you're buying more time, that's going to be better for your thesis, right? So you pay money for time, and that time helps your thesis play out. So say that you own a Tesla 360 call option expiring next week, right? That's a very short amount of time. And Tesla's at 350, and you're like, well, I don't know if it's going to go there or not, right? You're feeling uncertain, and rightfully so, because 1 week is not really enough time for really anything, right? You don't know what's going to happen in one single week. That's kind of gambling right there. So the call is losing value very quickly. So instead of watching it decay and you're not really sure what's going to happen, you can roll it higher. So you can go roll to a 360 call, but you can do that next month. So basically keep the same strike price, but roll it out to a further expiration date. So here's essentially a chart. So Tesla is still not going up. The option value is losing, right? So it continues to kind of like, kind of go sideways here, and the market prices of the stock is not really doing what you want. So you basically close out this old option, which is expiring very, very soon, and then you add a new option that has 45 days to expiration, right? This little line here should be kind of like a little bit over there, right? So yeah, let's say that you have 7 days here. So that would be more accurate representation right here, right? So it's not quite going up, and you're like, well, I don't have much time. Let me open up a new option. But this one, instead of expiring, let's say this is 7 days, right? Now it's 45 days. So then you have a lot more time for your thesis to play out. And then boom, all of a sudden Tesla goes up because of the FSD or robo-taxi news or whatever news, right? Or whatever stock, right? So you open up a further out expiration date. And if you believe Tesla will shoot up and your thesis ends up playing out, boom, right? The stock goes to 400, you end up making a ton of money, and this roll ends up making you a ton of money. Whereas if you would have held to expiration, you'd be at zero, but rolling this out further, you would spend some money. However, it would more than pay off if Tesla were to hit, let's say, $400 in this example. So you sell the current call and you take whatever is left and you use that cash to help you pay for our new call option, right? So you sell this call option now while it still has some value left. It still has a week left. So you get rid of that, then you open up a new one. So if the new call option is more expensive, well, it's going to be a debit roll, and that's probably going to be the case in most cases, especially when you're buying options. The more time they have, especially if you add a lot of time, they are going to cost you money, but it's well worth it if a breakout happens in the stock. And if the call is already in the money and you want to protect profits, you can roll it to a higher strike for a cheaper price, and you can basically lock in gains like that. So rather than selling the option completely, you can sell the option collecting a lot of profit and open up a cheaper option down the road. So basically still continuing your play, but taking some chips off the table and collecting a profit. So it's a very similar idea and the same idea for puts. So for calls, we're rolling out to mainly give more time. Well, the same thing is for puts. So let's say that you have Apple and it's at 205 and you own a 215 put that's expiring pretty soon, let's say. right? Your position's on Apple and it's in the money, so it's in the money by 10 bucks. So you think the Apple drop really isn't over, say that you are a bit more concerned, so you want to roll a little bit down. You're like, I'm pretty happy with Apple at 215, but it may go lower and the Apple isn't performing as I thought it would, so I want to roll down. So you roll to 210 put a month out, and maybe that costs you a small debit, but if you pay, let's say, 30 cents, but you move down by $5, well, you get it, right? You pay 30 cents and you move down by $5. It's great, right? So this gives the stock more room to fall and it gives you more time to profit. So interestingly enough, I actually have a pretty big trade on Apple right now. So let me show you how I would be rolling Apple, because I currently have an Apple trade that's very close to the money. So Apple is at 201 right now, and I have a couple of option positions actually. So let's actually take a look at my history, because I believe that I just have rolled this very, very recently. No, I have not. I had options that expired profitably. Okay, so instead, let's take a look at two of these positions, right? So let's open up, let's do an example on a sell put and a covered call, and these are both pretty good to roll up or down, okay? Let's start off with the call option first. So Apple is above 200, right? I'm actually up on this option position. You can see that I'm up $7,300. I'm up on the position. If I were to simulate the returns right here, I'm gonna get a pretty nice profit here. If you can see here how if Apple stays at the same price, then my profit only continues to go up, and I'm gonna make over $30,000. I do have a big position on Apple, and I did sell covered calls at a very favorable price. And that's why I have so much profit despite me being in the money. So being in the money does not mean that you're down, and that's a big misconception. A lot of people are like, well, I'm in the money, I'm losing money. Or, you're really not. Oftentimes, if you do a covered call and the stock goes up, then you've made money on the stock, you're just down in the covered call itself. Or in my case, I sold a covered call here when Apple just, had more volatility. It was a little bit higher. And I did a in the money roll, I believe. So yeah, you can see here I actually rolled this option up over a month ago. So I ended up buying the 205 and I sold at 200. So this is actually an interesting case, and I'm throwing a lot of meat and potatoes at you in this video. This is hopefully that you're grasping this pretty well. You can rewatch this, of course. I'm just going through real examples and really just going into the meat and potatoes of what I'm actually doing so you can learn from this. So right here you can see that I actually ended up doing something unique, which was I bought 205 call and then I sold at 200. So funny enough, I actually did exactly what I said that I usually don't do. So you can see how rolling is very situational. Part of this presentation I was saying that you can roll for the same dates. I said I usually don't do that, but no, I actually ended up doing exactly that on my Apple trade right here. It's funny enough. So ended up buying 205 and then rolling down to 200, and then I collected a net credit on this trade of $7,050. So funny enough, rolling is very situational. So in this course, I'm going to try to do my best to keep it like fairly beginner friendly, but rolling is probably the most advanced and situational based topic, which is why I recommend that you look into my boot camp for rolling, because just working with me hands-on, going through your own portfolio is going to be the best way to learn and really scale your portfolio, and it is really case-by-case basis. So rolling is something that I usually don't cover on YouTube because it is so hard to really teach perfectly. It's a lot of experience, and that's why I do like to do it more hands-on, either in my boot camp or my one-on-one coaching. So you can check that out. Both of them are the first link. You just schedule a free consultation, learn about the pricing of it, and see if it's a good fit for you. But let's continue on with this course. I'm just going to keep showing you lots of examples, and we're going to continue on with my notes. So anyways, I used 205. I bought back 205 and 200, collected a really nice net credit, $7,000. And obviously this is worth a lot more. This is worth like $28,000 left. But look, so let's say that I'm bullish on Apple, right? Let's make a bull case on Apple. And let's say that, this is first of all, a really great position, but let's just say I don't want to let go of Apple, okay? Simply said, I don't want to let go of Apple at 200, and this option is approaching expiration. So here's what I'm going to do. I'm going to roll this position, and I can simply roll back to 200. I actually would end up making a good amount of money. But also what I can do is I can just go out farther in terms of date. So let's say I go for December, right? This is going to add a lot of time. So if I roll up to December, I'm going to move 200. I can easily move it to 210, right? Easily. I can move by a whole $10 and still collect a net credit of like $10,000. And that's because, first of all, it's a fairly big position I have. Second of all, I'm adding a lot of time. 126 days addition to this position is pretty long. And going from 200 to 210 is, of course, like pretty good as well. So I get $10 more of upside. And yeah, I'm adding, 4 months. That's not little. That's not little at all. So 4 months of time, but you can make a ton of money on the upside, right? So this is an example of, let's say you're bullish on Apple and you don't want it to go, you don't want to lose your shares, or you want to have more upside. So that's an example of a roll up. And I do this all the time. So this is really an example, but this is literally what I've been doing for Apple so many times. You can actually see, if I go to show more here, you'll see many rolls in my history. So roll, dividends, roll, short call, roll, right? So I have a lot. Right, and that's me selling some shares. I had a lot of shares before. Okay, so let's now go over selling a put and rolling down a sell put. I believe I have rolled this sell put. No, I have opened this position from scratch yesterday during my live coaching call. So I did this because we wanted more exposure into Apple. I thought this would be a great trade for my community. So I ended up selling yesterday 5 contracts of Apple, 197.5. That expires on July 18th. I'm slightly down in the position, not a big deal. Apple is still above my strike price. I really would not take any action here at all, but let's just say that hypothetically you were concerned and you wanted to roll this position lower. You wanted to protect yourself, roll this position lower. So yeah, let's go over that. So let's go to roll this position, and yeah, it would just roll from July out to, say, just a little bit more, nothing crazy, just a little bit more, maybe, August 8th here. It's a non-traditional expiration, by the way. But yeah, I would go from 197.5. Let's say I wanted to go a little bit lower to 195. Yeah, basically here you're going down from 197.5 to 195. You're adding 21 days, not a big amount of time, 3 weeks. And you would collect a net credit here. So you would collect $900 and you're moving down. So that's like really, really amazing there, right? So yeah, let's talk about rolling covered calls in a little bit more detail. I just showed you an example on Apple. I showed you an Apple covered call roll up and a Apple sell put roll down, okay? But now let's go over another example. So let's say that you have a covered call. So covered calls are perfect for rolling. They're very simple to roll. You can control whether you keep your shares or if you let them go. So if you're cool letting them go, that's fine. If you're not, then you roll. So let's go over Microsoft. So let's say that you own 100 shares of Microsoft at 460 and you sold 470 call for $2, right? Now Microsoft's trading for 475, which Microsoft has exploded in value. So this was a good example that I've written here in my notes. And your call is now $5 in the money and it's very close to expiration. So if you do nothing, you'll be assigned and your shares get called away at 470, right? If you want to keep the shares, you could roll the call up and out maybe to 480, 485, something higher, and the strike expiring the following month. So you'll likely pay a small debit to buy back the 470 call and sell a 480 because that's pretty much a lot of upside room. But if you were to buy back a 470 and sell like a 472, for example, 472.5 probably they have available. Honestly, it would probably be like a zero cost roll, right? It wouldn't cost you anything. So you would just roll up and it would cost you nothing. But if you go from 470 to 480 and Microsoft is in a really, really bull trend, then of course, yeah, you've made money because you bought at 460, right? So you're doing pretty good. But to roll it up, you're probably gonna have to pay a debit. But if you pay a debit of, say, $2, $3, I mean, who cares? $2-3 to pay that to get $10 of upside, not a problem at all. Like, that's still really amazing, right? So if the stock falls back down, you still collect the original premium and you avoided assignment if you did nothing. And if you rolled it up and you're somewhere in between here, then you still don't get assigned. You're good. Covered call rolls should match your goal. So collect more income is probably your goal, or stay in the stock longer. That is and or your other goal. Most likely and. So you want to have income and you want to stay in the stock longer in most cases. If a stock spikes hard and you're deep in the money, it's often better to take the shares and re-enter at a better time. If it's a long-term holding, rolling allows you to participate in more upside while keeping the trade alive. So that's really why I do up and out roll a majority of the time. Sometimes you'll get to roll for a credit. You get to buy back for 470 call on Microsoft for 3 and sell a 475 for 4. And that's really ideal, right? So you're moving up in terms of like how much money you can make, and you're collecting income along the way, which is like a huge win-win. Other times it can be a debit, so decide if the roll cost is worth keeping the position active
active or not. Sometimes it's really not worth it. Sometimes it's just better just to close and not really roll, but just close and let the position run further. Don't really wait until the last hour to decide. Rolling works best when you still have some time left. So I typically roll during my sessions. I would say I have Monday and Wednesday sessions. So if that week is Friday, I will typically roll like on a Wednesday, or sometimes if I think that it's not ideal to roll, then I will wait until that Friday and I'll have my session on Friday instead. Okay, so we already talked about rolling a cash secured put. We looked at Apple and basically rolling Apple lower. Rolling cash secured puts is about extending time or improving strike price when the stock drops below your put option. So if you sold a $200 put on Apple for $3 and now Apple drops to $190, here's what it looks like. Essentially, it dropped down and you want to go from the old sell put to a new sell put. Even if the stock is still dropping down, at least you're buying it for $195 instead of $200. And if you roll for a net credit, well, cool. I mean, you just beat all the other stock investors by a bit. Your put is $10 in the money if it goes down to $195. And if the expiration is approaching, assignment is very likely going to happen. So if you don't want to buy 100 shares just yet, or just want to simply reduce your average cost, then all you do is just roll lower. So for example, you buy back the 200 put and then you end up selling the 195 put for next month and you take in a little bit more credit. So you take a credit and you move down and you lower your obligations. And this buys you time for the stock to recover and lowers the level at which you would be assigned. If you're okay with owning the stock but want to delay the purchase or reduce cost basis, then rolling helps. Especially when it comes to delaying, you can just delay, and continue to sell or roll those put options. It's literally like getting a discount on a stock. It's literally like forcing a discount and getting paid to do so. Sometimes rolling is neutral, so you can close out a 200 put for $10 and open up 200 put for next month for $11 and just collect some credit. So you're not really lowering the average cost, right? You're still at 200, but you're collecting a credit and you're delaying. So oftentimes this credit is going to be a lot bigger. I put $1 here, but it's going to be a lot bigger if you're not really moving the strike price, because time is a really huge factor. If the stock rebounds before the next expiration, you win with more premium collected and no shares assigned. So if Apple keeps falling, you'll need to roll again or accept assignment at a now lower cost basis. Now, don't roll forever. You see, if you're rolling 3 or 4 times and the stock keeps falling, consider cutting or just taking ownership of the shares. The thing is, oftentimes, if you roll too much, that's also not a good thing because the stock will likely bounce up. For example, imagine a stock that's just falling down month after month, 3 months in a row. Well, the more it falls down, if it's a good quality company or it's a decent company, it's unlikely to continue doing that. It's unlikely to just experience so much bad luck many times in a row. So if you continue to roll down, say a short put option, then that stock will have a really fast recovery. And although you will make money, you will really miss out on a huge bounce. So keep in mind, whenever I roll, you don't want to roll too much, especially if it's selling a put option. Now, if it's a covered call, then you can roll basically forever. And the reason is because with the covered call, you want it to go up as much as possible so you can keep rolling up and up and up. But with a sell put, the more you roll it down, well, you're going to miss a big increase in whenever it recovers. Rolling a cash secured put can be either an income tool or a capital protection tool, depending on whether you want to own the shares or not. If your plan is to run the wheel strategy, which we'll talk about in just a second, then rolling can delay assignment while stacking more income in your favor. But of course, if the stock fundamentally changed, don't just roll blindly, reevaluate your thesis. Think of it like this. Here's a picture. So if there's a fundamentally weak company, then you're just standing on a very weak foundation. Whereas if it's a fundamentally strong company and you're rolling options, well, that's a good thing. Let's talk about rolling a covered call within the wheel strategy. So the wheel is about cycling between cash secured puts and covered calls. And if you're not an expert at the wheel strategy, I have a free video on the wheel strategy in my playlist. It's a whole free course on the wheel strategy. Now, so check that out if you don't know what it is. But after assignment, you own the shares. Now you're selling calls against your shares for income. So let's say you were assigned 100 shares of Palantir at 130 after selling a put option, and you got assigned here, and now Palantir is going up as it has been since IPO, since I purchased it. Every single dip has been a buying opportunity. But yeah, let's say you got assigned here, and now the stock is going up a lot, and you had a covered call as 140. Well, you definitely want to roll it up because you don't want to lose shares, and then keep in mind when you lose shares, it's a taxable event, right? So you want to just keep rolling it up. So if Palantir is at 135 and you sold a 140 covered call
for $2, right? And now Palantir quickly spikes to 145, and you want to keep the shares. All you have to do is just roll up. So you go from 140 to 150, right? So, and you can do this, by the way, by just rolling it by 1 month. So you may have to pay a small debit, by the way, and that's fine. You can't always roll for a credit, but now you've locked in $10 per share of unrealized gains, and you still get to sell some premium. Most likely it'll be a credit if you go long enough, but in a 1 month period, it can vary, right? It can vary depending on factors like implied volatility. Now, rolling lets you stay in the game while basically respecting the rules of the wheel. So you can stay within the wheel and not have to restart the wheel. So rolling kind of keeps you within the wheel without having to restart it, okay? I wouldn't say there's a necessary advantage to that because you can sell your shares and then sell puts again. And, the wheel is sell puts to get in, get assigned. Once assigned, sell covered calls. If assigned and you lose your shares, then you go back to selling puts, and that's why it's called the wheel strategy. Just keep going in that circle. The real benefit of rolling up with the wheel in the last step is not letting go of your shares so you don't have to pay taxes, okay? But if you're trading in a non-taxable account, then you don't really care. You can get rid of your shares and then just start selling puts again. You don't need to roll, okay? So rolling is really, I guess, kind of like a tax management strategy. I'm not a tax advisor or anything like that, but I have a lot of experience. So I'm not able to legally give tax advice, right? You always want to contact a professional, but I will say that I have a lot of experience, and if you are interested in getting connected with someone in taxes, or if you simply wanted coaching more around managing your wealth and rolling, then I suggest that you schedule a call for my one-on-one coaching. It's going to be a very good fit because I can give you a customized plan. So that's the first link in the description. Now, if Palantir had instead fallen to $125, your 140 call is worthless. So you don't have to roll it. You just let it expire, and then you just sell say a 135 or something like that. Rolling calls inside the wheel is more about really trade-offs. So it's like assignment versus really collecting more premium and upside. So it just varies whether you want to do that or not. It is situational based. So it's going to be kind of difficult for me to tell you in all situations, right? Because it just depends on what account you're trading in the position, and your cost basis as well. But generally, if you're up a lot of money, you probably don't want to pay taxes, especially if you're an American and you're living, anywhere in America. There's just a lot of taxes, right? Every time you sell, you have to take your profits and pay IRS and all. So that's just not ideal because you have a drag on your income via taxes and having to pay the tax man. But you can literally do simple math to figure out if rolling is a good fit for you or not. It also, of course, taxes, cost basis, and whether you're trading in a retirement account or not. So here's the wheel, by the way. Here's a little picture here just so you can visualize it. I told you verbally, but here's what it is. It's selling puts. If assigned, sell calls. Stock gets called away, then you restart the wheel strategy all over again. Now let's move over to talk about rolling leap options. So leaps are long-term call options. They're often at least 1 year until expiration. I've been making a lot of videos on leaps. If you've been watching my channel, if you're subscribed, which you should be, I have bought leap options on Nvidia before it has run up a lot. So it's been extremely profitable. Now, leaps are long-term call options essentially. So rolling leaps is all about compounding gains and managing long-term exposure. So if a leap option goes really heavy into the money, it's good to take some profit off the table, and that is via rolling, right? So you can see here's an old leap option that you purchased for 500. Let's say it was in the money and the stock just went up a lot. It went up to let's say 650. And this is an example on Meta, right? Meta is in the 700s, I believe now. As I was making this course and all, it takes a lot of time. So there we go. Meta is 717. So my examples are making money. All right, it's awesome. So basically, if you had a leap option and on Meta, you've printed money, you've literally printed money. And now what you would want to do is you can take some off the table, close out the 500 and open up a 600. So this would basically get you $100. You're going $100 higher. It's going to be way, way cheaper. So your leap was deep in the money and worth maybe 160, and unrealized 100% plus gain, right? So let's say that you don't want to just hold and risk giving up some of that capital back. All you really do is just close out the 500, open up a 600, and just lock in a bunch of profit. So for example, maybe you purchased this 500 for $80, right? And then you just close it once, this is up a lot, you close it for 160. So you basically double your money. Okay, so let's say you bought it for 80, then you sold it for 160, and you just buy a new option. Okay, so you double your money, you buy a new option, and you can buy it for 80. So now it's you have no risk on the table because you've doubled your money, you made 80, now you reinvested 80 into another call option. This time, whether it happens or not, you'll break even. Oftentimes it'll be even cheaper, so you will have a gain if you have a significant move like that. So basically you can lock in profits, and then your new leap option is cheaper and closer to the current price. Rolling up helps you reset your cost basis. It also helps you manage delta and extends time without really closing out your bullish position. So it's still the same long view that you have on the stock.
So some traders even ladder rolls every 6 months. They might be up a lot, they might be up a little bit or even down, but they just like ladder the roll, and every 6 months they roll their leap up and out as the stock grows. Because like if you remember in the beginning I talked about like theta and time decay, and theta and time decay really starts to kick up a lot higher as you approach expiration. So as a leap option gets closer to expiration, let's say it's like 0 and then here's the year, and it gets to like the halfway mark, that's why traders will oftentimes just ladder roll and just take the 6 month option back to 1 year. So if meta drops from 650 to 580, for example, and your leap is losing value, you can still roll down slightly to recover the delta. Say you go from a 600 strike to 550. So you can roll up or down. Basically, it just has to meet your viewpoint. So if you're still bullish on the stock, then you roll down because that makes it easier for you to break even when it does recover. So just keep in mind, rolling down usually costs you premium and it's going to cost you money. You can't roll down for free. It's definitely going to cost you money. But again, it's about protecting your exposure. So if you bought a leap option because you're bullish on the stock, it won't really matter that the stock is down. If you have that long-term belief, then you should roll your leap option lower. That way, when it does recover, then you have a more sensitive option that recovers faster. Rolling leaps works best when combined with the poor man's covered call income strategy. So selling short calls as a hedge and adjusting both legs together. So yeah, let's talk about poor man's covered call. If I'm going a bit quick, I do have a full video on the poor man's covered call, and that will be in the description. I have a full course on all these option strategies, and this video is maybe a little bit more advanced because we're talking about rolling, but it's very important to understand rolling. But it is of course a more advanced topic. That's why it's taken me so long to make this video like this. Now, the poor man's covered call strategy involves holding a leap option and selling short-term calls against it. So basically, it's kind of like creating a synthetic covered call position. And it's synthetic because you don't have the shares, you don't have 100 shares, you just have a call leap option. And that leap option is pretty much a replacement for shares. So when you're rolling a position like this, it gets a little bit more complicated because now you have to roll two separate positions, separately. Like you have to roll one and then you have to roll the other. So the roll here is really twofold. You can roll the leap itself, and you can roll the short call regularly for income as well. And it's going to depend. And let's talk about an example right now on Microsoft. So say that you hold Microsoft 300 leap option, right? And then Microsoft is trading at 460, right? So it's a lot higher. And you've been selling 480 calls each month. Okay, so you're producing income, things are good, right? Again, 300 leap option, you're long 300, and Microsoft's doing great. And then you're just basically selling covered calls a little bit outside of the money. So if Microsoft's at 460, you're selling 480 calls, you're selling essentially $20 out of the money, $20 up, right? And then you're collecting income. So that's what it looks like, right? By now, let's say 1 month, Microsoft spikes to 490 and your short call is in the money. Like, what do? Well, you don't want to lose upside, so you end up rolling the 480 to 500, right? So when we're talking about rolling, it's as simple as that. So if Microsoft shoots up to 490, then you close out this old sell call for 480, and then you open up a new sell call for 500. So you close one option, then you sell another option, which is that's the way to go. So you don't want to lose upside, and you just basically just roll up. It's as simple as that, and you can roll out by 1 month. So that might cost you a small debit, but you regain room for upside and you avoid capping gains. So you let your gains continue to run. And this is incredibly important. Right now, we're in a bull market. My portfolio is doing incredibly well. And one of the main positions I have is SoFi. And I've been, telling my members SoFi, I've been saying Discord members, every time I have a call, it's always like, we got to trade SoFi. And SoFi has made us a significant amount of money, but some people have decided to do covered calls on SoFi. So it's very important for them to roll up because SoFi, you're just capped, right? You're capped, you can't make any more gains. That's exactly where the situation of rolling up will come into play, and it may cost you a debit. And that is what it is because you're making a lot of money fast. You're going to have to roll up for a debit and spend some of that money to regain back your shares. Or of course, don't sell covered calls to begin with. But this course is all about rolling. So when you're already in that position, what do? If the leap gains too much and becomes deep in the money, you can also roll the leap itself from 300 to 400, right? So you can, again, take money off the table. So locking in gains and resetting your delta. So always match the leap's delta with the short call's delta. So don't sell too aggressively or your leap won't be covered. Okay, it's very important. So a good leap delta, it's always good to rebalance, to that 70 to 80 mark. And then a good covered call or sell call,
on a leap option or not a leap option, either way is the same 25 to 35 delta. So this is always where you should be rebalancing. So when we're talking about rolling, it's really like rebalancing back to a good place where you have upside and you have good exposure without it being, too high or low. I can make a whole separate course on delta, but I'm going to just keep it simple. This is like basically the sweet spot deltas, right? Without getting too complicated and advanced. So if Microsoft pulls back to say 430 and your short call expires worthless, you can just keep stacking income with a new covered call at 460 or 470. You can just unlimitedly keep selling covered calls if it expires. Course, right? You'll really only need to roll when it is in the money. And sometimes I don't even roll when it's in the money. I wait until it's like more deep in the money. Rolling short calls and poor man's covered call is your regular paycheck. So you can lock in profits on a monthly basis and basically just count it as your monthly paycheck. When both are managed correctly, poor man's covered calls become powerful rolling machines, really collecting income while maintaining bullish exposure. So it's really one of the most perfect strategies, especially in a bull market. I'm going to be honest with you, I have a whole lot of notes here for rolling debit spreads, but I just don't really do that because rolling spreads, you're working with like two different options, so it can be very difficult. Debit spreads are obviously net buyers of premium. So when you're buying a debit spread, you pay to enter the trade. So if your outlook hasn't changed, but the stock is moving slowly, you might roll to get more time, right? That's really a good time to do that. Say you bought something that's expiring in 3 months and now there's only 2 weeks left. Well, it's good to kind of roll that because 2 weeks is really not enough time and you want to kind of preserve the capital that is still on the long bullish debit spread that you have, right? If it's a call debit spread or a put debit spread. Say for example, you have Tesla, 330, 350 call spread, and you paid $6 and now Tesla's at 335, but time's almost up. You're kind of in that like territory where you're about to break even like any day, but time is running out. So here's like a more complicated chart of what you should do and how you can roll a debit spread. So yeah, again, here we have an old buy call and an old sell call, right? That's your debit spread. Yeah, you're like right here, right? So at this point, you decide to roll. Let me zoom in here. Okay, let's zoom into the chart. At this point, you decide to roll your call debit spread up and out, hoping for the stock to go up, right? So you don't know if it's going to go up, but you have a sense that, hey, I'm bullish. I believe it'll go up. So essentially, you roll up. So you buy a new bull call spread, and you close these two, and then you buy a higher leg, and then you sell also a higher leg. And because you have a lot more time now, maybe it's weeks or a couple of months, then you can go higher, and whatever amount of money that you salvage here, you can put it towards this trade right here. And then again, look, say that your scenario happens where you think the stock rises, and it does. So Tesla ends up going to like 360 plus, and then you end up recouping all of this money plus a lot more. So you close the old date and you open up some new dates, and that's really strong strategy. And even if it costs you like a one debit roll, it gives you more time and higher potential payoff. Very strong. And this only works if your thesis is still intact and you think the move is just delayed. Okay, so if it's just delayed, then yeah. This is also same with the bear put spread. So let's talk about a bear put spread and how to roll that. So say you bought Nvidia for like 140, 120 put spread, and it drops to like 135. So you're making money, but the stock is like really not moving in your favor right now, but you still think the stock will drop, right? So then you can just like close out and then go lower. So you're betting on something more aggressive to happen. You're betting on the stock to fall down more aggressively, but you have more time for it to do that, right? And again, if you're not familiar with these strategies, I have a spreads masterclass as well. Like I recommend that you go to my playlist, and then I have option trading courses there, like free courses, and this is like one of them, right? So your spread is worth less than you paid. You roll it to the next month, maybe with a wider strike or more time. It's all about like manipulating strike and expiration dates to meet your worldview more. So it's all about like, what is your view? And then how can you roll to make your view more profitable when it happens? So don't just roll because you're down also, because that's also a mistake. Like you also have to know when to like cut it and like quit it. And it's pretty difficult when you're buying debit spreads to know that, because the market is pretty random. So if the trade is clearly wrong, it's better just to cut and re-enter clean later than rolling into weakness. So let's talk about rolling credit spreads. Credit spreads are a lot more, profitable, and that's what I typically do trade, like a bull put spread or a bear call spread, or just a put credit spread or a call credit spread. So credit spreads are powerful because of defined risk. And that means that rolling is more complex, but overall, it isn't that bad. All right, so let's just say that you sold a put credit spread on Google and you like sold a 165 and then you bought a 160. It's very similar actually. So like right here, you see it's like 165, 160, and then you expect the stock to go back up at this point. So like you roll, right? So like you notice that Google's like pretty low and you expect it to go up. So what you do here is basically like you just go down a little bit on a put credit spread. So like you just go down slightly. So it's in the money and you're like, I still think I can make money on a put credit spread. A put credit spread, by the way, is like a bullish strategy. So what you do is you roll and it's like your new strikes are like a new sell put right here and a new buy put. So like you just go down from 170, 165 to 160, 155. And then once the stock recovers, then you're good because like this is your green profit zone. And then here would be like you would actually be losing money on a spread. Like quick reminder, on a debit spread, you want something to happen. On a credit spread, you're betting that it won't happen. So here we're betting that Google won't go down. So when you roll down, it actually helps you a lot. So you collect $1 risking $4 to lose, right, on a credit spread. And if Google drops down to 162, your short put is in the money and your expiry is coming, it makes sense to go down. So you can roll the entire spread to next month, close both legs, open a new spread with the same or new strikes. Here's a new example. You see Meta. Now this is going to be a call credit spread. So a call credit spread is when you sell a call and then you buy another call. So it's a call credit spread where you have a short call here. So you can see an old sell call here and then a buy call here. So you're selling at 660 and then you're buying at 665. And then if Meta were to rise and you expect the stock to kind of chill out, then you would just like roll up here, right? And because this is a more expensive stock, you can see that it doesn't really make sense to like roll up by like $5. You want to roll up by a lot more. So you can see here that I'm showing an example of rolling up by 20 from 660 to 680. So your old sell call and your new sell call is $20 apart. And that's just because the stock is a lot more expensive. So you would want to roll up a lot more for you to break even. So you would close the spread here, 660, 665, and reopen at 680. 685 for next month. And you'll often do this for a small debit, but it saves your spread from its max loss. So it's really beneficial. With spreads, rolling is always about managing defined risks, so don't roll endlessly until you're improving your position. One good rule is only roll spreads if you can improve probability, reduce loss, or extend time without going way off strategy. All right, so let's address rolling with a small account and like what actually changes. So rolling is still possible with small accounts, but margin and buying power matter a lot. So if you have a smaller portfolio, you're not alone, of course. Like I started with a small portfolio myself. Like here's me back in like 2015. At this point, I was like scaling a $2,000 portfolio, and then I got up to like 57.15, right? So like this is like pretty early. Like this is like my first year of trading in 2015. So I mean, it was still very possible to still scale a small portfolio and roll. You just have to be really aware of the buying power that you have. Of course, part of my journey, I was still at $100,000, and rolling was still very big part of my journey. And eventually I scaled, right? Like here's like kind of me at my peak at 4.3 million. My portfolio could be over 4 million, but I've been withdrawing money because I've had to pay like some taxes. Because like if you make money as a coach, which I do coaching services, I had to pay taxes. So I did withdraw some money from my portfolio, but essentially like I'm at my all-time peak of investing, and it took a lot of time to do so. And rolling has been a really big part of that. By the way, this is a video I do recommend that you look at as well. But I've experienced having used rolling in different parts of my journey, from a small account to like at 6 figures, at 7 figures. And it's pretty much the same process. Rolling works the same way as long as you pay attention to your cash. Sometimes I've wanted to roll for a debit, and then I realized like, whoa, I have no cash available at all. So I wasn't able to roll. And that's like the only like situation you have to be aware of. Of course, if you have like a small account, I wrote here that you do have to take slightly more risk. Of course, like if you want to scale up, like you just have to take on more risk. But the amount of risk that you take, it's really up to you and your investing goals. So when you're rolling options, basically a roll is pretty much always going to benefit you if there's more time on the option. So whether you roll like $5 or $10 or more, they're still all beneficial. So rolling in general, it's kind of hard to get it wrong. That's the good news, is as long as you're rolling, for example, on a covered call up and out, you're good. And if you're selling puts, then rolling down and out, you're good. It's also good to stick to defined risk rates. So spreads are great because you know how much you can lose. If you have a small portfolio, you pretty much have to do spreads. Otherwise, it's impossible if you have like a 5K, 10K portfolio to even sell a put option on Tesla, which will cost you $30,000. So when you're looking at trading something like Tesla, then yeah, you can go for like $5 spreads. That's basically my sweet spot. So if you want to scale your portfolio and learn how to roll even better, it is very difficult to cover rolling and every single detail of rolling. Some of you guys have huge positions that you need to be smarter when you roll because you need to have proper asset allocation and risk management to the position. While other positions, if you roll too aggressively, then you just leave money on the table. With other positions, you don't even need to be rolling at all because sometimes when you're in a bull market, you should just close the position, not even roll, and just give yourself upside. It can be very difficult to know when to do that. So I encourage you, if you want more help, more hands-on help, I do one-on-one coaching. So you can also check that out in the description where I can hands-on help you decide for yourself, help you with your retirement, help you generate more money, and help you get to your goals a lot faster. All the information, the pricing, the program, and your individual situation can be discussed on a consultation call, and that's absolutely free for you to look into, and that is the link in the description. So I hope that you enjoyed this video, and I will catch you in a future video.